why don't I just buy Activision stock? If Microsoft's buying them at this huge number, and I honestly didn't have they kept saying, is this an arbitrage play? Fast forward, Warren Buffett, Omaha, announces he bought Activision because he said, you know what? I don't know if regulators are going to agree with this one. I don't know if any one of the 30 countries are going to agree with it. But I do know one thing. Microsoft has the money. And he's betting that the deal will go through. And he even said, if it doesn't go through, I don't know how much money I'm going to lose. I could probably lose a lot of money. But I do believe that Microsoft will be able to make this play happen. I believe they started buying Activision last year as a value play.
Yeah, so he got into Activision before they announced this. So, I mean, the wisdom of him. But they, $68 billion, Microsoft, one of the biggest acquisition of any company. And so they announced they're going to buy at 95. What is arbitrage for people watching? Because this was confusing to me. I didn't know.
So this is an arbitrage play in the sense of you're buying an asset at this price, knowing full well that it could, knowing that with high likelihood it's likely to go here, and you make the money. Real arbitrage is the example he's given is you buy gold in New York at $200 an ounce and you sell it for $210 in London at the exact same time. It's an arbitrage opportunity. In this situation, there's a time difference. So people are betting that between the time it was announced, the time it happens, that right now the market's basically saying, what I read the price to mean is the market doesn't think it's going to happen. Because the market really thought it was going to happen, the price would be very close to the actual strike price. So Warren Buffett's belief is, hey, listen, I think the market's wrong on this one. I think there's a lot of opportunity up here. And he has said, if we're wrong, I don't know how much money might lose. Maybe they won't lose any money. But he was buying it, I should say, Berkshire Hathaway was buying it last year as a value play. I don't know if Warren himself was doing it, but he was buying it as a value play. And if he's right, he's going to make a lot of money. So for people in our chat, and for people out there watching, this could very well be an arbitrage opportunity. But Seth, how much money did you invest in it?
$3,500 out of $500,000.
Oh yeah, but your net worth is $750, $800 with everything, so it's less than half of 1%.
I see.
Do it with something fun.
I'm not YOLOing like
correct.
YOLOing my life savings.
And if it works, he'll make a good buck, and he won't regret not buying more. I mean, he might sit there and say that, but remember, if it doesn't work, his $3,500 could easily go to $2,000.
Mm-hmm.
So that's the play here with the arbitrage. And Warren Buffett is a brilliant man. And he was very open and said, this is what I like about Warren Buffett, Seth. He always sits there and says, hey, this is the guess I'm making. I could be right. I could be wrong. But my goal is if I have 100 of these things, when I'm right, I'm going to be right a lot more than I'm going to be wrong. And that's the play here. Even though it's one opportunity, his view is, all I know is Microsoft's got a lot of money they can afford to buy this thing.
Our dear friend Trader Mo bought some more of this just a few days ago. If you want to trade Activision, you can join him in the Bidnass Nation. But Paul, let's look at the 8 pillars and show what Warren Buffett saw in this company and all the positive things to buy this.
Okay, so we go to our 8 pillars software. Type in Activision Blizzard, ATVI. Again, it's at $79 a share.
And I have to congratulate some of the folks in our community, Paul, because they were talking about this alongside. I mean, this has been a hot topic for a couple years now, and you guys have been really good on this. Keep going.
So first things first, it's a $61 billion company. First pillar, we want the 5-year PE ratio to be under 22.5. Activision Blizzard is 36. So a little bit pricey. Does that mean it's a no-go? Absolutely not. Maybe there's a lot of growth potential. Gaming is going to be a very high. I look at it a lot like music. The people who have the games and the content and it's like streaming are going to win that war. Activision's got a lot of great titles. That's the big thing Activision has going for it. Pillar number 2, we want the return on invested capital over the last 5 years to be greater than 9%. It is 10.5%. So check mark there. This means they are good at investing the money that's invested in the business. Pillar number 3, we want to see revenue growth for the last 5 years. So we go to the income statement in our software. $7 billion to $8.8 billion. Check mark there. Growth in their sales. Is it a lot of growth? It is not. And remember, the higher the growth, the more you should pay as a PE ratio for the company. So keep that in mind when you look at this growth being, 22%, 24%. So keep that in mind. Pillar number 4, we want net income growth over the last 5 years. So we just scroll down a little bit, $273 million to $2.7 billion, 10 times more. But keep in mind, this 273 looks like a fluke because it was $1 billion the year before and $1.8 billion the year after. But still, their profit is up over the last 5 years.
So Paul, pillar number 5 is shares outstanding.
Yes. So guys, in a business, when they're buying back shares, They're rewarding the shareholders who are there as long as they're paying a reasonable price for stock, undervalued stock. They're giving you a higher percentage of the revenue and profit in the business. When they're issuing shares, they're diluting you. They're bringing on more investors, more shareholders like you, and splitting up your revenue and profit amongst other people without your say. So we go here, the very bottom of the income statement. The end of 6 years ago, 740 million shares outstanding. Last year, 771, and it's up every single year. Is it a big amount? It is not. But okay, I mean, if it's an expensive stock, I don't blame them. It's better than giving debt, but it's something that concerns me. Now, pillar number 6, guys, is the debt of the business. So what I want to do is I want to go back to the main page of our software. I'm going to look at the 5-year average free cash flow. Call it $2 billion. I'm going to multiply that by 5. That is $10 billion total. We want their long-term liabilities to be under $10 billion. We want them to be able to take their previous 5 years of free cash flow, and if they replicate it again, be able to pay off all their long-term liabilities. So we go to the balance sheet, and we go to their annual balance sheet, go all the way to the bottom. Total long-term liabilities, $5 billion. So that's a check mark there. They can easily pay off their long-term liabilities in under 5 years. Pillars number 7 and 8 have to do with that free cash flow. So we go to the cash flow statement. And guys, free cash flow is cash from operations less your capital expenditures. And a company can do one of 5 things with that money. Buy back shares, pay down debt, reinvest back in themselves, make acquisitions, and pay dividends. Okay? We added this line to make the math easy for you because this line is not in other financial statements.
Yeah, I don't want to do that math, Paul.
Correct. So 5 years ago, they did 2.06. Last year, 2.33 billion. Check mark there. If you remember, the average was 2 billion. Our final metric, we take their average free cash flow last 5 years, we multiply it by 20 for a starting point on what market cap we want to look at. 2 times 20 is $40 billion. Guys, the market cap was actually currently 61.6 billion. So this is an X. It's currently selling for over 30 times free cash flow. So for those of you who don't want to do all that math, we have the 8 pillars tab right here. It shows all of our metrics. So guys, we have a few X's here. We have valuation. If you remember, we were looking at this company based on Warren Buffett started buying it. So since then, the ROIC has gone down, but this was actually a check mark. And we have the shares outstanding as an X.
We have to remember that Microsoft is buying this company. So I was going to ask you, what did Buffett see in this play? But really, what did Microsoft see in this company? And they have $63 billion in free cash. They could easily afford this acquisition.
Yes.
And so they make that per year. But so really, Buffett's making a play on another company potentially buying this.
Well, a lot of people are saying that Buffett's using this as a way to get into Microsoft. Because, you know, Buffett and Gates are very close. They're best friends. So a lot of people are saying, did he know about the Activision deal? And I trust Buffett when he says he did not know about the Activision. He's like, no, of course I didn't know about that one. Also, Gates is not running Microsoft anymore. Does that mean he doesn't hear things? Of course he does. But he's not running Microsoft anymore. Warren Buffett made this play. He saw value somewhere. I'm going to go in the stock analyzer tool to see where that value might be, because right now, from this standpoint, it's hard for me to see that. But the stock analyzer tool is going to let me take my assumptions about the future and determine if there is a value play there. Because remember, if a company can grow its revenue and profit 100% a year for the next 10 years, I would gladly buy it at these valuations.
Paul, this is a unique case, though, in that we know what this stock price is going to. Quote,
that's why
quote,
it's a
unquote, no.
That's why it's an arbitrage play.
Yeah. So, I mean, do we have to run stock analyzer on this? We know it's going to 95, and that was my play on this.
Yeah. So we're looking at it from 2 standpoints. One, do you think the merger is going to go through? If the answer is yes, buy the stock. 2, if the merger doesn't happen, do you want to own the stock at this price?
I see.
That's the question. So we've already answered the first one, which is, hey, I think the merger is going through. Should I buy it? The answer is yes. The second question is, if it doesn't go through, do I want to own the stock? And why did Warren Buffett buy this back then? So let's go to the stock analyzer tool.
Good point.
So guys, when it comes to revenue growth, the revenue growth isn't that great. It's 5.8% a year for the last 10 years. So I'm going to go conservative, 3, 5, and 7. Let's say they have some gangbuster years making some great products. Profit margin, I'm going to go 20, 21, and 22%. Free cash flow margin, 25, 26, and 27. PE, 14, 16, 18. Same with the price of free cash flow. And finally, guys, my desired return of 12.5%, because I want to buy an individual stock. If I buy an ETF, I'll make 9 or 10%. So give myself margin of safety and a reason to buy the stock. I hit the analyze button. Guys, I don't see it. I see a low price of 25 to 30, a high price of 40 to 50, and I just don't see a mid price of 30, somewhere in the 30s. I don't see what Warren Buffett and Berkshire Hathaway saw, but I didn't see what they saw in Verizon, and they just announced, by the way, that they exited the Verizon potentially. I don't see this here. I'm going to hold on this deal. I don't care for the arbitrage opportunity. That's my opinion. But if you believe the deal will go through, buy the stock, wait for it to hit the acquisition.